Hi, this is Randy Finney with the right side of the chart, and this is a closing market wrap for Monday, April 7th, 2025. I'll do my best to keep it brief. Not a whole lot to add on the equity markets from where I started the day. We did close green. That's a plus. Nothing to really go high-fiving, but that was my expectation today. It's the reason for coming to the week long and even adding to those longs today, especially once we saw that T3 level get recovered. So all in all, could be a dead cat bounce. That's yet to be determined. What I can tell you definitively, if we hit that third target, where a reaction was likely. In fact, we kind of moved on there today. I won't even call it a reaction yet. We closed above it, and that's it. So we undercut it, momentum fueled overshoot. Again, we have the potential makes of a selling climax. Let's just talk on that real quick. There are no guarantees. Let me turn off all the line. You can see my volume bars down here. There's no guarantees that we can't continue to drop, and in the selling climax, you see these bars build. That's possible. But again, we're looking at the highest volume. Let me try to do this for you. Going back to here, I'll show you if you can't see my volume. I turn it up. I like these, a lot of things turned down on my chart so they're not super busy. That didn't work because when I put a line up, it throws back all the other annotations on that chart. I need to turn these off. I'll hand draw it in for you. From where we're at now, let's grab this arrow tool. We have to take it back all the way to right here. We had a little, I missed that. It's right here. I was a little to the right of it, a little near term, but not the end. That was a start of a selling climax, but that one ended more of a whimper right there. You did have a little bit of a rally there. There was this was the first leg down. We had the first big double-digit counter trend bounce in the last bear market. That was early 2022. We gamed that one, covered that the other day. We went long at the lows there based on 60-minute charts. Turned around, sold right there at the highs, almost milked it to the penny there. And again, that one you can see the big volume bar right there. That was a near term, the first. And that's similar to what we have now. So I'm going off that as of now. I've made clear since late last week that the RR to short is just not favorable. In fact, let me just expand on something. Well, I won't go to it. It's in one of the comments under the last post I made before this one. Somebody talked about Kramer for calling for a Black Monday today, or some call on that. Look, my reply is obviously I don't think that's happened. I can't. But I went on to say I certainly don't take that off the table. The most important thing I've been watching diligently: the financial sector, broker dealers, everything, the credit spreads, junk bonds. We'll talk on that real quick. And so, if something may have broken, you might not know it. You usually don't hear, you won't hear about it until after it's announced. When I say broken, again, been doing this a long time, that's, again, a financial institution, a hedge fund, something that can have ripple effects when it blows up and therefore has to liquidate positions. Again, a big fund could be that. Then it can have a cascading effect on the financial markets. There's always that real possibility. And I would be extremely remiss not to point that out. Now, not my preferred scenario. What I'm seeing, and I wish I was reading, headlines all over the weekend. Was it Friday or Saturday? I read something, and it was from a reputable publication, be it Barron's, Bloomberg, the Wall Street Journal, something. And it was a pretty detailed article, and they must have they quoted at least a dozen of the big names in finance. You got them all were in there. Not a one of them, about the tariffs and the market situation, not a single one of them was remotely bullish. They were all doom, gloom, and again, the analysts tend to be a lot wrong. Even these big names you see over and over again on TV. So what I'm saying is that's a pretty good extreme, and we know fear is everywhere. Everyone I've talked to, the VIX is showing us. We'll get to that in a second. So, guys, anyways, this is, let me just summarize things. So I think, again, we're looking at a bounce this week. Today was a start, nothing big, no high-fiving at QQQ. I shut off the after-hour trades just to show you where we closed the day. If I toggle that back on, we're drifting a little up in the after-hour session right now from where we closed. But so we eked out a green close. And certainly, at least it just shows that at least today, the momentum has waned, especially when you look at the recovery off the lows. You just take today's low, See, they bought it up big. There was some rumor. Somebody put out a false rumor about the Trump and China, and then that was debunked, and the market went back down. But it still managed, with all that being said, it managed to close green and also recover from where we closed today. Again, I have the line turned on to the after-hour trades shut off, so we closed from low to high. That was a 5.5%, as you can see in the pop-up box to the left. If I can grab that low right there, to where we parked at the close was a 5.37% recovery. Nothing big, really, considering the volatility. Everything has to be put in perspective. You might say, Randy, are you kidding me? A 5%, off the lows. Again, if you look at, these are the daily moves lately, are 5-6% in QQQ. So everything you have to put in perspective. The ATR, which is called the average to range, that goes up. That's how much I just toggled it on. We'll show you. It's just relative to volatility. It's how much the daily swings in a security. So ATR is high right now. You don't have to turn it on your chart to know that. Obviously, you just have to watch what's going on. So that's it. So we'll take it. And again, I just go off levels. I go off the fact that the markets, we've been hitting support since late last week. We went through a couple. But again, the big ones, I always put the highest weighting on my price targets. Those are the big levels where reactions are likely, and that was it. So far today, a hit in the expected momentum-fueled overshoot of that Momo-fueled overshoot, and a recovery back above with a green candle. So we'll take it. I'm going to get to VIX in 1 second. I just want to talk bigger picture now. Go out to the monthly chart. One of my favorite indicators, I've been sharing this with you regularly for years, especially recently, is this: you turn off all the lines here, everything else. The 20-month exponential moving average, that's its blue line, does just a phenomenal job of defining trends. It's what I call my 401k indicator, even though admittedly I've been in cash for a while, knowing this, expecting this to come and finally move some in. It's not my wife's. I run my own business, so I have a SEP. I don't have a 401k. I have 0 employees, but in that, because and that she can only cash as her options, cash, stocks, bonds, or that's it. International, large cap growth, mid cap growth, no shorting, no commodities, no nothing. A typical Schwab 401k, like most employers, and so therefore I had a lot of dry powder, and so that's for a tactical bounce. I'm still looking. From here, 10 to 15% bounce, and it was not an all-in moment. No, it was a fractional move-in from a almost full cash position. And I'm just speaking to kind of my mindset here now, where you go back out of a 401k. If you, again, this is in my head, my plan, and stay out is when you're clearly below the 20-month exponential moving average. All bear markets have been defined by that. Bull markets have been defined by the indexes being above it. And you want to look again on the monthly chart. All that matters is how the month closes, not intramonth. Right now we're down, and that's why I wanted to jump to it. We're down intramonth. But remember, we just toggled. I highlighted this. I've been highlighting this all up to the highs recently. The PPO on the monthly chart, just a beautiful indicator as well. And look for these bearish crossovers before it even happened. I said you don't have to be an expert technical analysis. Just look at the histogram. When it's going down, you can make a pretty accurate prediction about when it's going to cross. So we just crossed, and my point is we just triggered. Last month was the first month. Remember, April is early in the making. It's April 7th, guys. So we have a long way to go. However, it doesn't matter. We had my confirming sell signal last month. Again, like I've said, there's just been a plethora, a ton of check marks for the bearish case. Where am I going with this? To me, I'm looking at, we'll see where we close a month. I'll most certainly cover that on the last day of April. Once a month is over, I expect we'll probably close down below it. I highly expect that. So if you just want to kind of know my macro play here, my best guess scenario, and that may change. Obviously, everything's subject to change, and if the charts change, is a intramonth bounce. Well, this is this month's candle. This candle's not going to go anywhere. It's going to turn and morph the fat part, the body, the skinny part called the shadows are the highs and lows for the month, and the body, the fat part, is the open and close for the month. And so right now, this is where we close today. That's why it's a red candle. So all I'm looking at is an intra-month bounce, and I suspect this by the end of the month, we'll close back down. We'll keep the PPO indicator on a sell. If not, if it's a whipsaw, I'll adjust. It'll be one thing. It's not my be-all, end-all. But again, so I will most likely be back. I'm looking to just game a bounce. If you do that, and look, I'm not encouraging this for anybody. I'm an active trader, and even in my long-term accounts, in bear markets, the rallies, when you get them, are double digits. They're 10 to 30% easy all day long. If this indeed is what that is, I will be able to say with a higher degree of confidence once we have a solid monthly close below the 20-month in both QQQ and SPY, just like we did right here. That's when this one indicator, again, it's not the be-all, made it official that you're in a bear market. You first had the early signs there. We were short off the highs for many reasons, starting with a breakdown on the 60-minute charts, then daily. Other things happened on the daily and 60-minute charts. But at this point there, that said, okay, guys, that's a long-term trend indicator. Well, that flipped there. So that would have the first kind of sign to maybe take you somewhere off, equities out of again, I'm just using the word 401k because that's a long-term account. Most people obviously consider a retirement account, and also one you don't have a lot of flexibility to trade actively. One warning is you can get hit with a lot of those funds within there. Some do, some don't. And even some 401k plans, some of the funds do and some don't within. I'm saying some 401ks as a whole do it. Some have it fund specific where they have, what do they call them? Trading restrictions. Where if you go into an investment, one of the mutual funds, if you sell it out within 30 days, they hit you with a short-term trading fee. So just be careful. Know what you're doing. And again, guys, if I have to tell you that, and I hate to say it this way, you shouldn't be trading in your 401k, but most people shouldn't anyways. I'm just kind of speaking to bigger picture, and hopefully that makes sense when I use these examples. So that's what I'm thinking here. I feel pretty confident, things will change. I listened to what's going on with Trump and you're going to up it up to 100+% tariffs on China. And again, they'll the powers that be aren't going to let the whole financial system crash. And if it starts to crash, you're going to see the Fed finally come in. I made some comments on that too. I have little doubt that Powell is probably, and I also have little doubt. I'm sure Trump's been on the phone with him. This will all come out later. He doesn't want to look political. He doesn't want to look like one of Powell's minions. Otherwise, he probably would have done an emergency cut, or at least the Fed officials would have started dripping a more aggressive tone that they're ready to stand by and step in and act if this market rout continues. Because remember, price stability is one of their objectives, and there's certainly not price stability in either the financial markets or in the economy where they talk about price stability. Keeping consumer price inflation from prices going all over the place, but one has to do with the other as well. So, anywho, that's it. So you kind of right now it appears as if both the Trump and the Powell puts have poofed up and vanished for years. When Trump was in office, and even when he got elected, there was that Trump put in place everyone thought we had because he loves this, mention his success on the stock market. And we always known forever and a day since the Yellen put before that and the Bernanke put before her and the Greenspan put before them. It goes back as far as you want. We've always had a Federal Reserve, in recent decades has figured that they found the magic formula to ban recessions and bear markets indefinitely by just pumping flooding the market with liquidity and low rates. But then inflation's kind of tied Powell's hands behind his back this time around. So that's where we're at. But those are all the things that will happen and are likely to happen. Is again, if we keep going down much more, you'll start seeing some emergency measures kick in. I don't see it right now. And again, you got to stay flexible. I'm open to anything, especially things with decent probabilities. Anything's possible. I always say that. That's a cheap saying in the markets. So I speak in probabilities. And right now, to me, just the probability of a bounce, I put a little higher than a probability of an outright crash or much more downside. But that probability is still elevated. and I won't rule it out, and I will act accordingly. But from this long-term chart, sometimes you just have to step back, keep it simple. There was a last bear market. It was identified by the bearish PPO crossover, by the PPO histogram down below the zero line. That was Q4 2018 drop. You had the bearish PPO crossover there, as I covered. COVID, if you blinked, you missed it, but you had the PPO go red for a month. And again, the government called it Ursa Interruptus, my made-up term for a bear market that wasn't allowed to happen by the government and the Federal Reserve and all global central banks. It wasn't just the U.S., obviously. It was all governments and central banks around the world. Okay, so there's it. There it is, guys. Long term, nothing has changed. I still maintain downside. I still, my longest term indicators right now flip, but that one's still a question mark because the month is very young. If this closes under the 20-month exponential moving average, as I suspect it will, then it's just going to further increase the odds that my long-term and deepest targets on SPY and QQQ, which again is roughly a 50-ish, a little shy of a 50% drop in the S&P 500 and about a 55% drop off the highs in QQQ. Again, that's as of now. As all my price targets are subject to change. I don't change them often, but every now and then I do. I'll either extend targets or truncate. You know, if I have right now T7's my final target on QQQ, something happens, I may move that higher or may move it lower. We'll see. But as of now, it's a target I maintained since last year and still stick with. There's the S&P 500. Again, I covered this before. Last month we had my confirming the bearish PPO crossover. It's not much, but it's there. You probably might not be able to see it in the video, but that's a red histogram. It means the lines crossed last month, and that put us on a sell signal. That was all the reason for me to keep pushing the bearish scenario and you know, in that mode of, like I told you, I just can't stand the people who say, trade what's in front of you, just trade the charts. Unfortunately, you have to pick a team in this world. You know, you can't play Switzerland all the time, and that makes a difference of, like I say, in the trading. If you're coming up to support, if you have a team, if you maintain a bearish bias, instead of buying that support, you're going to wait for a break and then short it, because if you buy that support, if there's good evidence it's going to break, you're going to lose. And so that's why I talk about picking a team. And there are times I have my confidence or certainty of where the direction's going is unclear, and then I just don't have to trade. You don't always have to be in a position, or you can keep it light. Again, my sizing of my positioning and how heavy I am, long or short, whether I'm hedged, unhedged, will depend again on my degree of confidence and another factor. So, but just to reiterate, especially for the new folks, that's it. So this is this month's candle, clearly below the 50-month moving average. You can roll this back. I encourage you to do it on your own chart. It's a exponential moving average, 20 period on a monthly chart. And I would, I've said this many times in the past. Again, if you're new to the site, you haven't heard this. On a scale 1 to 10, it's a 10 for a trend indicator. Why is it a 10? Because there's two components to me for any kind of market timing indicator or trend indicator. There's the complexity. Some folks, I've seen people using, trend indicators that have multiple moving averages and then other things in there. They might use some indicators and all kinds of other fancy stuff. And that's good if they can keep a handle on it. It gets a little hard to follow. So simplicity, if you're going to rank any indicator on both, you want to use two criteria: effectiveness, number one, first and foremost, and then simplicity. This one, it's that simple. You're either, when you're trading above the 20-month moving average, you're in a bull trend and you want to be long in your 401k. There was a period you crossed there. You can't see it, but that's 3 months or 2 or 3 months of red candles back then in the that was in the early 90s. Other than that, it's just done a phenomenal job. You buy pullbacks to it as well. When you're in an uptrend, you're looking to add to your positions, you come into some more cash, you buy pullbacks to it. You keep doing that until you finally have a clear, solid crossover. You would have milked all or most of the bear market after the dot-com bubble burst here. And then you were above it there. You took it back, kept you long and strong throughout the bull market leading up to 07 highs. You got out or profited from nearly in the entire bear market there. There were other reasons. It's usually the bear markets end quick. This is best used as far as timing goes to get out of longs and into shorts, because the bottom's in, and then it usually takes several months to get back because you get so far below that. Remember what I often say is the reason I love shorting bear markets and corrections. Stocks fall a lot faster than they rise, and they tend to fall in a much more impulsive manner. You can see there you wiped out in just less than a year and a half. You wiped out all the gains that took over a decade to make. Same thing here. So there was COVID. You wiped out years of gains in 6 weeks. So forth and so on. Here you wiped out over a year of gains, and this time we'll probably do the same. We'll probably wipe out, before all said and done, last several years of gains before we hit those longer term targets. So alrighty, there's where we're at, and we'll pick that up. And again, SPY is working on an even bigger red histogram bar, currently below the 20, but that doesn't matter. On April 7th, I told you where I think it'll close the month, but before then I think we'll probably have a good, nice double-digit tradable bounce. I gave you some targets today, about 15% upside on. And remember, QQQ is my trading proxy. It's why not? You're gonna get paid. You're gonna be right or wrong in the market, unless the financials are moving big. Then you have a big weighting in the SPY, which you don't have. And the Nasdaq 100 virtually lacks financials. So other than that, but I'll trade Nasdaq 100. So green day. Nothing big, but especially off the lows, once you saw the recovery coming, it's for those that might want to wait till get into this morning and not taking home any exposure over the weekend, to give you an opportunity to get in, maybe make something off that 5+% reverse off the lows. Alrighty, let's move on to Mr. VIX, the VIX Volatility Index. Like I said, this is what we call it. Its nickname is the fear gauge. And as mentioned earlier, we were there. We go to my weekly chart and go to this board. We hit the level where previous bull markets and corrections, all since 2009 to 2021, have ended. What happened to my circle tool? Let's go back to circle tool. Here we go. Okay, so this has been covered many times. This is pretty much where corrections have ended. This is where bear markets have ended since the financial crisis. We hit that one, and that's where we are today. So if the bottom falls out tomorrow, tonight, futures crash, something big goes on, and that is, again, a very real possibility. I just can't reiterate that enough. So the good thing, at least for me as a futures trader, the weekend's over. I can run stop loss orders. And I use stop limit. I like stop loss, even though sometimes you may not get the best fill price, but you're not going to get it bypassed. If you use a stop limit order on in the markets in the futures tank quickly, it goes past that, and if they can't fill you at that price, it stays open. You never get filled. So stop loss order, I can go to sleep pretty heavy, as heavy as I want, and stagger. I typically will use in a fast moving market, if I have a good position, I'll use staggered stops. Like if we're right here right now, and I think we're going here, stop 1, 2, and 3, that's out. And the last one, the lowest, is what I call a catastrophic stop, where I don't, something plunges, because who knows what happens. And then the VIX could certainly run up here, but remember, the way the bear markets work are almost all trends. You have waves, Elliott wavers will talk about, different wave counts, and the primary waves often being a 5 wave. And you could say this is wave 1. We haven't even had a bounce. I'm not going to start counting waves right now. Let's just not even go there. Let's just say, look, let's see if we can get a counter trend bounce going here. Any of that slightest hint of good news on the trade front, or even if the Fed starts coming out and maybe reversing course and saying that they might be considering a pretty, starting to cut soon, or maybe bigger than expected, that could do it as well. We'll see. And it can go the other way. So again, if you don't know what to do and you're uncertain what to do, just sit back and learn, or keep things very light, and don't fall in love with any one scenario. Okay, so the VIX is covered. VIXY, which is the VIX tracking ETN. That's our official proxy for those that don't use futures. We closed a little bit below, so far the reversal's good. I told you kind of I'm playing it by ear. There's a big gap right here, but more so I plan to cover the VIX shorts, reversed, and if and when it's time to get out of the bounce longs. Will I go back into the VIX? That all depends on what happens. Right now, short the VIX. I'm going to take that home and look for a pullback. Probably come back to about here or there would be the two most logical if I'm just looking at this chart. But the thing is, the great thing is, I don't have to only trade the VIX chart or VIXY. I look at VIX futures, I look at the spot VIX, I look at VIXY, and most importantly, I look at QQQ and SPY. Remember, the VIX itself is based off put and call buying on the S&P 500, not the NASDAQ 100, but they move in the same direction up and down. And so it's just, I look at them all. Told you I want to cover a few other things. Okay, I had questions today on gold, silver, crude oil, natural gas. Let me cover all those. No change. Somebody asked about crude. I give an updated chart. I covered that on Friday. Mentioned this is USO, the kind of first to market, one of the more liquid crude ETNs. ETNs maybe. $66, 66-ish. I have a support zone. I told you on Friday, 65.43 up to about 66. Either way, you can see it's a major reaction low. Big drop in crude, big positive divergence, and so crude still looks good there. It hasn't really moved much. We're still right at that support level, but I still like it, and you do have the positive divergence there. Natural gas, not so much anymore. I highlighted an objective long entry on natural gas last week, but that was at the trend line, and the trend line broke. This was it on the 60-minute chart. I can't remember if I gave you the daily or the 60 or both. There was the uptrend line plus price support clearly taken out, and therefore can't make a reason to go long. And if crude rallies, you might see natural gas continue to drop. They tend to move inversely only because when crude prices are high, they increase production of crude oil, natural gas being a product of that, floods the market, a little extra supply. But when crude really drops, they start shutting the wells, shutting wells down, and then natural gas prices can often go up. But right now, based on the technicals, unless it reverses or does anything, it's no good. So if you're in it, maybe consider a stop not too far below. It could reverse. That's a 60-minute chart. I just can't make a strong case. And again, this is the daily chart, the same level I told you last week. We were highlighting objective long here, so consider that one either stopped out or just no good. Again, if you have it, we could turn around or reverse. I don't have a strong opinion. This trend indicator right here, the PPO, we're above it. When the PPO is above the zero line, right, like this, the trend is bullish. When it's below, like this, the trend is usually bearish. And so sometimes that line acts as support. We could turn around and bounce. But so far, not great. Gold at support, somebody asked. Trend line support. Close a little bit above it, below it, I'm sorry, actually. Remember, gold has, and I've been talking about this for a while, big negative divergence. Probably shows well on the weekly chart. Let's look at this. So here's a weekly chart of GLD. There's the divergent high, big red candle, not quite a bearish engulfing, but a big red candle. And remember, the week is not over. If you're going to trade longer term time frame, then you want to look at the weekly chart. If this candle right now, we're pretty much closed on it, maybe a hair below it. If it can hold that, you might get another hurrah. But again, big negative divergence. So I don't like gold long here. I think it may bounce this week. I think if the market bounces, you're going to see relief and a return to a lot of risk assets. I have little doubt. Remember, I got bearish throughout gold as a short and silver and GDX, everything a couple weeks ago, saying that it meshed with my views for the stock market going down hard, and I was predicted margin call sellings. Forced selling, and said the same folks that have been loading up on gold have been loading up on the stock market, Nvidia, tech stocks, and all that, obviously because they've been moving together in a tight correlation. The stock market peaked first and then gold right after, and so they've both been rising. So that stands by that logic. The same folks have been buying both. Therefore, when they start getting margin calls on their Nvidia and their SMCI and their Amazon and Apple and all that, they get margin, they force selling on gold. But the technicals, anyways, that's what I go off of. And so we shorted that break of the bearish rising wedge, and it went down on that 60-minute chart and undercut that trend line. So that puts it on the 60 on a precarious position. Silver's at support. Somebody asked me, this is a 60-minute chart, but let me show you a daily here. This is a support zone. I highlighted this, I think, last week, support zone. So, they're at support, big negative divergence at that high. So that doesn't bode well, in my opinion, longer term on silver. And again, it kind of meshes with my outlook for the market. I think we'll see liquidation, continued liquidation in the metals. I think the same folks are still chock full of that. Might have had some forced margin selling recently. But I think when the market starts the next leg down, whether that's tomorrow or 3 weeks from now, will probably put pressure on the metals. Also remember, if that is the case and the stock market drops, same reason I was in a rare minority heading into this year that we'd have a recession in 2025 is because I said it would simply be, if no other reason, the fact that the stock market looked like it was going to poised for a big drop, and that in itself would be the cause for the recession due to the destruction of the wealth effect. And that's what they're all, most of them are saying now. Yeah, well, the stock market's down. The S&P crossed the 20% mark today, hit the official bear market designation. And so that certainly can't help consumer spending, can't help consumer confidence, right? In fact, it took a big chunk out of both. So, all right, so that's it. And silver is also more of an industrial metal than gold. Gold is an industrial metal, but it's also a precious metal and the flight to safety bid and all that. And so, but if you do get a recession, you get the demand destruction in gold, silver, that part of it for the industrial component, crude oil and everything else. And then there's a long-term trend line you can see that I think silver is going to. So if you're, I wouldn't short it here, just like the stock market. I suspect most likely to bounce first, especially if the market bounces and then down to this trend line here, which from where we closed today would give us about another 8% drop. And it could be more than that when I go out to the weekly chart. I look at this big divergence on the weekly chart right here, big negative divergence. And, trend reversal could bring silver all the way back down here. That'd be about a 43%, almost 50% drop off the highs down to about 1758 or so. So that's kind of, let's just call that my longer term target for silver. You can screenshot this. Here's my targets on the weekly right here. That's first support. We're at it right now, hence the reason, if anything, of the two, I'd go long right now, not short as an active trader. If that broke, I might short it and most likely will. Probably going to game a bounce. Do I have silver? I don't think I do. No, I don't have any silver at the moment. Might have it tonight or tomorrow. And then get a bounce if the market bounces. And then boom, there's the next target, that uptrend line. Price support at 23.83. Target, we'll call it target 2 if you don't count the trend line, 20.55. And then if things get ugly, that's again if things get ugly, all the way back down to 17.58. All right, you're up to date on the metals. GDX, that was a short recently as well. We shorted that break of the uptrend line, and it dropped in pretty short order, 12%. So congrats to you that either turned around and booked profit on your gold mining longs, or turned around and even turned that drop into an additional profit. Big negative divergence. I don't see the end of this at all. This looks like just the first leg down, coming up on support, probably bounce. But if I had to do one or the other, you put a gun to my head and said you got to go long or short and hold it for 3 to 6 months, I'd be short because of this chart. And big divergence there. And remember, at the end of the day, GDX does not hold gold or silver. It holds gold and silver mining stocks, with the operative word being stocks. In a bear market, most equities, including GDX, tend to fall. Even if gold's catching a flight to safety, I've seen it where the miners still fall as well, because at the end of the day, they are just that, companies, they're stocks. Anywho, there's the update on GDX. What else? Somebody asked about I don't want to spend a lot of time, but somebody asked about it. I talked about it in last couple weeks. I've hit on occasionally. I've backed off coverage on the grains. That's wheat, corn, and soybeans. Nothing's changed from a longer term perspective. You still have wheat at long-term excellent support. In fact, let me queue up my long-term wheat chart for those that are new to the site, haven't seen this one. Give me a second. I have to pause the video and log into that one. Okay, this is wheat. You can't see. Let me squeeze it down here. Try that. 1 second. WEAT. Well, this is the continuous contract on this charting platform. They use the symbol $ wheat. And that's, again, the futures continuous contract. Let me mush it down a little more. See if I can get the years down on the bottom. Nope, I'm going to have to toggle it down to a smaller size to fit it. Okay, so you can see the years down here. We're going back into the late 90s. This is the 2000 year break mark right here, right there. And this is a super long-term trend line that comes off that right at the beginning of the year 2000. Just a beautiful long-term uptrend line. I love this setup. But wheat's just been dead money. That was my reply a few weeks ago or last update when I commented it. Better fish to fry, I said elsewhere, but I'm keeping my eye on it. We're at long-term support. And again, it's not been going down. It's been moving sideways. It's tested this trend line recently. Positive divergence, everything I like to see. So what I call a very constructive chart for the long term, you get these bullish wedges on the weekly. This is a weekly chart. Or these divergent lows. This is where these big trends come from. It just hasn't started going yet. So we just need to see that. All right, so that's it. So it's been a dead money trade. Still have some long-term accounts. Like I said, too bad it doesn't pay a dividend, but I'm fine with it. Like I said, it looks constructive, but I'm not going to add to that until it takes that trend line out and starts to wake up, meaning starts to move up, start to break through some resistance levels. Corn, soybeans here, there's wheat on the, remember on the 60-minute chart, we've had plenty of trading ops. It takes puts in these little 60-minute divergent lows, 1, 2, 3, kind of like the VIX, the way we've been trading the VIX now since last year. We keep hitting these little 60-minute divergent lows. We get in, we've gained all the pops. I don't think we missed a single one of the double, even triple digit pops over last year in the VIX, including the most current one. And that's kind of the 60-minute charts have been our guide getting in there. And you have it. You have a divergent low here. So nobody wants wheat right now. It's boring. I'm watching it. I don't have, I could probably now see, I like to have a trend line or a horizontal level to break to trigger. That's it. You could put a downtrend line there. And if we get back over this level here, it keeps making marginal new, meaning ever so slightly lower lows. And then it pops. That's the MO lately. One of those pops I think will be the real deal when we take out that downtrend line on the weekly chart. Again, I don't want to speak too much on it. I still like it, and if it starts to wake up, then keep an eye on it. And if I don't mention it, bump me on it. Please feel free to. I don't want to miss the run. I think there's a big run coming up in wheat probably this year. I thought it would start last year, and it's so far, like I said, been those little fits and starts off the 60-minute chart. Corn's, now remember, the thing is, I've talked about corn is still up. We had that divergent low there, and unlike wheat, which keeps eking out, running along the bottom, making slight lows, we're still in an uptrend. Corn's still holding that uptrend line, still off the lows. These are the same long-term targets I gave you last year. We hit my first target. We hit it again here recently. We just need to take that out. So we need to move up there, and then we should go on to hit the remainder of my targets on corn. Wheat usually follows corn, and when it lags behind as it has been, it usually plays a game of catch-up. So I think wheat will outperform once these guys start to run. Soybeans are the other big grain. They all tend to move together. Remember, we hit my first target already. Still off that divergent low. Just needs to take out this downtrend line for your next buy signal. And being the fact we already hit T1 should open the door up to my next targets there. So there's your update on the grains. Again, right now they're just kind of dead money trades. So, you can watch them. If you have any, just set stops appropriately and just keep an eye on it. All right, what else? Let's just run through the Mag 7 and then we'll wrap this up. Okay, let's do that. Individual stocks. Let's just see how they look today. Let's go to a weekly chart and start with Apple. What boards do I have for you? That one's busy. Apple really, and this is putting a lot of pressure on the market. We all know Apple was overexposed to China. They're doing their best. Today they announced they're going to start doing some production on their iPhones out of India, temporarily at least, so they can get some, manufacturing done in the U.S. or get an exemption. They're looking to get an exemption on the tariffs, which we know they'll get. Apple's an icon of the U.S. tech sector and just the U.S. as a whole. Again, all this stuff will get resolved. If it doesn't, the world's coming to an end. The world's not going to come to an end. We're going to have a bear market. Don't get me wrong. We're going to go down, but the first big relief rally is going to come when there's, some agreement and positive news on the trade tariffs or something else. But I think that'll most likely be the catalyst for the first big double-digit rally. And most folks will think that that's it. It was a great buying opportunity. You'll have the so-called geniuses come out. So I told you to buy, and we're going to new highs. And just when everybody starts to believe it and it feels like the real thing, that's about the time it'll be over, and then we'll look to position short for the next leg down. And look, the next leg down we still may go. Like I already spoke to that. To me, it's about RR. Bulls make money, bears make money, pigs get slaughtered. So Apple, if you're looking at Apple's kind of in no man's land. That's what I call when a stock's between support and resist. Actually, no, there's support. You see, I had a level at 180.31. That line I created back in 2023. We closed at 181.46. So we're closed on support. If it goes lower, if you're looking to buy Apple, this is even better support, in my opinion, right here. 165.71, really a support zone from about 166 down to 158. That's actually better support. So if there's a little more downside this week, Apple and the market should find support there, because Apple is the market. It's still the biggest. As much as it's been getting hammered lately, it is still the largest component. You can see on my my watch list, these are the components here. Apple's still the highest at 2.8 trillion, Microsoft 2.7, Nvidia 2.3, and so forth and so on. And remember, the NASDAQ 100, just like the S&P 500, where Apple's also the largest component, those are market cap weighted indexes. So the biggest weighting, the biggest market cap puts the highest impact on the sector, or the index, that is. So there's Apple. Add support with the next support. Let me measure it for you. If we do drop this week, you're looking about another 7% down, 8.5% to 8.5 to the bottom of my range is about 12. That's the downside. And I think we're going to go there, but I don't know this week. I'm still leaning towards a bounce first, minimum, max, and then that. So this is kind of my outlook for if this would be, this is the good news here. If we get some pretty good news on the trade wars right there, that we'd get that higher bounce, if not lower bounce. Microsoft, I've had these lines here forever where it's going ultimately, but kind of closing no man's land. This is not a good chart, guys. I'm sorry. That was good support. That line at 363, pretty decent. There is a little minor support. I'm going to add the line now. I always do this when I do these videos. There's an all-time high back in 2021 when the stock peaked, and it comes in. So right here, there was another reaction high, another one there, several reactions there, a breakout candle. So yeah, I should have had a line there, and I do now, 350. So yeah. I missed it before on my weekly, but Microsoft just closed at support. And so we'll see if it holds that. NVIDIA cut through, remember T1, these are the targets I laid out last year. This is still my final target. That just says potential. So they're not current targets. I don't think the stock's going that far yet. I may add it. That's when I give you targets. If I say the word potential, it means right now that's not where I think the final target will be. But I'm open to that possibility, and then I'll extend that. So if I remove the verbiage, you can't even see it there. It's dimmed down, but that's why the measurements are there. T4 is still the final target, which I've long been calling for about a 70% drop from the highs in NVIDIA. Today, remember, we hit those targets were laid out back here. We went up, made a marginal deny. We already hit that first target. We hit it again, and we closed today right about on it, 96.74. I have it at 97.64. I have the level at 97.46. Again, that's the line created way back then in 2024. And that's it. So this is so far, the week isn't over. This is a weekly chart. That's what I call momentum field overshoot. And we snap back and we're on it. So why I'm doing this is I'm showing you all the market leaders. The top 8 stocks in the NASDAQ 100, everything else doesn't matter. If I can show you that 6 or 7 or 8 of those 8 are at good support, then it doesn't matter what the other 92 stocks in the NASDAQ 100 or the other 400 and something, 490 in the S&P 500 are doing. Unfortunately, because the weighting is so big. These mega cap, these $3 trillion companies are so large and have such an impact. That's all you have to follow. They will dictate where the index goes. So that's why I focus on these. And that's it. So if we crap out this week and this support doesn't hold, this is probably where we'll close by the end of the week or in the next week or two. My second target, it's at $75.96. We'll round that up, call it $76. And that's that. By every metric, long-term charts, I feel obviously even stronger now than I did up here, that those targets, but I had the highest degree of confidence on that even back then. I never wavered or waffled on this. And when we broke the trend line, we put in the bearish engulfings, we just had, the market was being held up. The AI bubble had just animal spirits roaring, and that was it. So we had just a mountain of technical evidence. We've turned the corner. We're below the 200-day moving averages. PPO is starting to cross down below that 5.93 level, which delineates, in my opinion, bull and bear trends in this stock. So we'll watch. And this is a weekly chart. Let's see how the week closes. If it closes on or above this level here, that's bullish, especially rally back up. At this point, I don't know if we're going to get it. Bear markets usually don't make it easy, especially for what I call JCL shorts, Johnny come lately. They didn't want to short here when we had the first sell signal, or here. They want to short now because they see the stock coming down, or they want another back test. Well, we already got the breakdown, the back test of the 200s. Now, that doesn't mean we can't get it again. If we do, it's still going to be an objective short level. Usually bear markets, the way they work is they unfold very fast. They don't like to let the longs out easy. They cause pain to the longs. And if you're a short seller who's a little waffling, has that waffling type mentality, no, I don't want to, too late. So, and then you don't get the objective entries. And what happens is you have to short no man's land. And I won't short no man's land in the market, because that means, you're smack between, it's what I call when you're smack between support and resistance. Let's say right here, when we get down between T3 and T2, there's no support, zero support, in my opinion, between there. And I don't short there. You're probably going to go down all the way to T3, but a snap, you get those, you start getting very oversold. Just single day or 2-day short covering rallies in a stock like this can mean 20%. And so, I like to either short on a rally back to resistance, especially when overbought conditions are worked off, and or a break of support, especially after a period of, after that support level's been, after a period of time above there and we're not oversold. So then if you look at it this way, there was a break and we're back there right now. Could be objective short entry. We'll see. Like I said, my thoughts. So right now, just holding tight. I don't have this one individual. I'm just kind of showing you collectively what these guys are doing here. Amazon back to that 176-ish level. Is it an intraday week down, intra-week breakdown, or just a back test? We'll know soon. This bounce doesn't materialize soon, we could head down to these next support levels. There's one level I should add for you here on this Amazon chart. That's that previous low right there from August 5th of 2024. Alphabet on support 104.13. Next support is this uptrend line. That's a long-term uptrend line. Comes all the way back from when the stock came public in 2004. That's what I call the secular primary bull market uptrend line. And I have a high degree of confidence that target will be hit before all is said and done. The million-dollar question is, are we going to go straight there right now? Possible. Or are we going to bounce first? More probable, in my opinion, than get there. And then I think ultimately that breaks. Again, I've been calling for and talked about it in one of my comments today, a new secular bear market. A lot out there, and I think even maybe some of these folks on TV, they don't even realize that. We've been in a secular bull market since most people listen to my voice were born, and it's been a while. And again, if you're new to the site, why, Randy, how do you come across with this super long-term bearish? Where are you getting all that from? It's all about interest rates. I've talked about this for years. This is TNX, the yield on the 30-year Treasury bond. TYX, you can look at TNX. TNX is the 10-year. We can go there too. And it's simple. If you know Economics 101, or even you don't have to be an economist, you're just well-versed in the stock market. It's simple. Falling interest rates are bullish for stocks for two reasons. Number one, this is the downtrend line. This is when rates peaked. We had rising rates, high inflation back into the 70s, peaked in right in the beginning of the 80s. I think Carter going out of office, Reagan coming in here. That ended that. We had a multi-year bear market back in the 70s, stagflation, all that good stuff. And we embarked on a new secular trend of falling interest rates. It's very simple. Falling rates are bullish for the economy and the stock market for two reasons. Number one, it lowers the cost of capital, therefore companies will expand. They will build new production facilities, plants. Businesses start up. It's easy to start your own business when you can borrow from the SBA. It's going to back half your loan. You put up money for the other half. A bank will put up money for the other half. I mean, you borrow 4 or 5, 3, 4, 5, 6%. It's easy. When rates go up, and now it's 10, 12, 15%, it stifles economic growth. So that's one reason. The other reason is simple: the alternatives. Both individuals, and institutions, i.e., namely pension funds, who have to guarantee liabilities to the pensioners, will start to move money out of stocks into bonds when they can get a guarantee. The way this works here, the scaling on the right, move the decimal over 1 point. This is the percent. So that 50 is a 5% yield on the 10-year bond. That 110 is 11% yield. Yes, that's where rates were. They did peak back here around 18%, 17, 18% back in the early 80s. And so this is the other reason. So incrementally, every tick higher, a certain amount of money moves out of stocks. Think people are going to retirement that now see this volatility once again, can't take that. They can't afford the risk. They don't have the time horizon. And especially big institutions where a lot of the money is, pension funds who have to meet those liabilities. They cannot risk that money. They will get fired. They have a fiduciary responsibility. And so they're going to move money out of low when rates are low. And the Federal Reserve actually has literally come out and said this before, that they've cut rates in the past simply to do that, to force money into the stock market and out of bonds. And so when you have rising rates and the Fed's lost control, I've talked about that before. And again, it's simple to me. By every technical metric, we took out the downtrend line, the primary downtrend line in Treasuries right here. That right there was evidence. But before that even happened, you started a new uptrend, taking out on all the pullbacks. You were putting in lower highs and higher lows. So by every technical definition of the term, from my analysis at least, we've begun. This is the start of a new uptrend. Now we can have a couple years of rates falling back here, all the way back here. We can backtest the trend line, and that doesn't change what I believe to be the trajectory of rates. So we've started, I believe, a new secular bull market in interest rates, an era of higher and rising rates that are going to, at best, kind of put a lid on the stock market and give us subpar returns for the next decade. Doesn't have to be negative returns. Wouldn't surprise me. In fact, I'd favor most likely the stock market being lower, especially 5 years, 10 years now. So where I differ from most is even the most ardent bull is going to say, yeah, bear markets are inevitable. We're going to have them. But they only last about 12, 15 months because they're looking back in recent history. They're looking over this period where we've had the strongest bull market in history because this is the strongest secular bear trend in rates, especially when Fed started getting cute with quantitative easing and zero rate policies and then hit the nuclear button when COVID came. That's what gave us this last blow off top in the stock market, as the excessive stimulus, especially when the economy proved to be on solid footing, and they kept it going, and they kept it going through the Biden administration with the excessive fiscal stimulus, with the Inflation Reduction Act and everything else, running wartime deficits and peacetime, excessive government spending, excessive zero interest rate policies from the Fed has juiced things up. Therefore, there's going to be a lot of damage, I believe, done. And they've burned up a lot of dry powder at a time they didn't need to. And I'm just trying to put you guys in my head why I'm looking at. Now, the good part is, if I'm right, and I may not even be right, this market can go to new highs on the moon. It's going to go there, and I promise you I'm not going to be short the entire time if we go to new highs from here. Hopefully I'll flip over and see the error of my ways and change my outlook and positioning and ride that wave up if we're going to hit a blow off top in the market this year. I certainly won't rule that out, and I will hopefully be long most of it if we do. With that being said, the bear market I see coming, again, we're spanning back. This chart goes back to the early 60s. The bear market I see will look a lot like this bear market in interest rates, which, remember, was a bull market in stocks and bond prices. Falling yields means higher. There'll be plenty of, this is a secular bear market, and these are cyclical bear and bull trends within that secular market. So this is why I hope that I'm correct, because this is a swing and trend traders dream, this kind of market. And it's my type of market with my type of skill sets of technical analysis. So, I think if we're looking at a 10-year bear market, a secular bear market, the bull markets within there, the cyclical bull markets, are going to be very, very profitable to trade, and likewise the bear trends as well. And so we'll hopefully continue to navigate it. We'll look at things like key moving averages that you want to short during those trends. You recognize that, and it tells you when the rallies are most likely over. And there's, they could tell you right there. I had a 192. I play around with different moving averages. That's the period moving average. It seems to contain bull and bear trends in the Treasury yields. And you can see we clearly took it out. I just have just a mountain of evidence again that, this wasn't just a pop up after COVID, that this was the end of the bear market rates. And therefore, this is going to, if correct, give stocks headwinds for the coming years, if not decades. Alrighty, just under the hour mark. I told you I'd try to keep it as short as possible. But again, a lot to cover right now, a lot of moving parts. Please don't ever confuse my long-term analysis. Like what I just rambled about, that's all long-term stuff. I'm either going to be right or wrong on that, but I'm not going to position for where I think the 10-year yield is going to be in 5 or 10 years, nor where the stock market's going to be in 5 or 10. It does formulate my overall bias, which again, you need to have. And even to an extent, the shorter term bias as well, when we're going to break out or below key moving averages. But that's it. If you want anything else, if I forgot anything, missed anything I've been covering lately, or anything I haven't covered and something you see, post it in the comment section below. I'll get back to you as soon as possible. After this video, I'm going to wrap up for the day, so I'll get back to you tomorrow. This has been Randy Finney with Right Side of the Chart. Have a good one.